And I think the $50 high is a joke right now. That could come out in 48 hours or the next 2-3 weeks or whatever. But in the next handful of months, I think the move up in silver will be so dramatic that people they'll be jaw dropping. I'm just saying right now, the next couple of quarters is so dramatic that it drops your jaw. And it's not uncommon. In other words, when you get into these phases, and that is fairly uncommon, but it's not uncommon that when you get in those phases, you do what I'm talking about. And in terms of multiple gains, it's merely replicating and getting back to even somewhere near the real dollar value that it saw in 2011 or certainly 1980. And also, like I said, certain other base metals and gold is well above its 2011. Why is silver the dog? Is it really a dog or is it a mistake? And I'm arguing this is one of these market mistakes that we see. And when they get exploited, they're worth exploiting. Undervalued, huge buy. Overvalued, huge short. And that's what I think silver's in right now, and I think it's going to compensate for it. But it's not going to do it in a way that is leisurely. Where, I'll have to think about this. Don't think too long. It's already said I'm accelerating.
In today's news recap, how China could claim a much bigger slice of the world's gold trading business. China reportedly has plans to invite some countries to buy physical gold and store it within its borders in the country's latest move to expand its reach into the international market for the precious metal. When it comes to gold, China is the world's biggest miner, a net importer, a large central bank buyer, and a key consumer nation. But it lacks any kind of bullion banking market, and trading through the Shanghai Gold Exchange remains very much domestic, said Adrian Ash, director of research at Bullion Vault. China's central bank, he noted, is keen to change all this. The People's Bank of China plans to become a custodian of foreign sovereign gold reserves by using the Shanghai Gold Exchange to court central banks in friendly countries to buy bullion and store it within the nation's borders, Bloomberg reported Tuesday, citing people familiar with the matter. MarketWatch sent an after-hours request by email Tuesday for comment on the report to the gold exchange in Shanghai. Building stockpiles of gold ready for leasing and loans would be a key step to establishing a bullion banking market, Ash said in Tuesday commentary. However, another key step would be to ease the restrictions on exporting bullion out of China so as to keep domestic prices more closely in line with global quotes. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
An acceleration phase in its trend. And similar events, technical events like that, and they could be defined, occurred back in 79 on the way to the 1980 high, and also in 2010 on the way to the 2011 high. Now, both of those highs were roughly around $50. So everybody in the world knows, silver's hit a high twice at 50. And if you just stand back a bit and think about it, gold's way above its 2011 high. Even copper right now, on this pullback in copper, is still trading above its 2011 high. Metals like I think I looked at a zinc chart the other day, or was it 10? I forgot. Above its 2011 high. And silver, I guess, is just going to stay below the 1980 high and 2011 high forever. It's a dog. Okay, right. Or something's wrong. Something is wrong with the pricing of that market. And we all know, if you've been in markets long enough, some markets can get overpriced vastly and stay there and yet seem so sane. And then when they implode, you say, oh, golly, it was a bubble. Now I understand. That guy was right. The big short guys, remember, they said they were going to collapse. The mortgages finally did collapse. Or a market gets bashed down so low and stays low for so long that people just write it off. Like it's never coming up. It's mired in mud. It's something's wrong with it. Those can be mistakes, market mistakes. And when a market makes a mistake and finally realizes it's made a pricing mistake, Not all markets move rationally, remember, okay? It can often compensate even more so getting back to what it should have done already, okay? And if you factor in such fundamentals as the real value of the underlying money unit, in this case, let's say the dollar, same applies to the euro and the yen and so forth, fiat pieces, nothing backing them, they decay in value every decade dramatically in real buying power because the quantity almost doubles for the dollar, for example, every decade, almost by 90% increase in the supply of dollars. So, like I've probably said this before, when your granddad built a house, it was $4,500 medium home price. Now it's $450,000. Okay, get the point? Okay. Another way to express it is 25, quarter of a century years ago, same month, September 2000, if you bought the S&P, you're up 3.5-fold right now, okay? If you bought gold, you're up over 11-fold or 12-fold by now. It's held its value and stayed ahead of the decaying money unit that we use to measure things. Whereas some things have just barely kept up with it, like the stock market. Even though they look good on the price chart, it really isn't keeping up with the real value of the underlying unit. Well, silver was $50 in 1980. You want to try to compensate for that, for the real decay in the value of the money in it? Would probably be $200, $300 just to match that price in real dollar terms. Now, forget that. That's not a technical, that's just a fact. Silver's been vastly underpriced relative to gold, underpriced versus other metals for too long, and it's waking up. And when it wakes up, it's likely to have a tantrum. And the tantrum has only begun. We thought, based on one or two factors that I could identify, that maybe we'll find some profit-taking resistance in the 60-70 zone after we burst through the 50, run all the buy stops, the latecomers. Frankly, looking at more soberly and looking back in time, measuring this type of move, it wouldn't shock us that silver's in excess of $100 sometime in the first quarter. Okay. And getting there will be obviously rapid. We're in one of those phases now where silver's not only going to catch up to reality, catch up to what some base metals have done, catch up to gold, it's going to beat gold. It's already been beating gold this year. In fact, silver's up double digits more than gold's up year to date. Much of that occurring since April. Gold went into this, sideways, silver went vertical. Anyway, I think we're in an interesting time, and that's one of the factors in markets I'm most focused on personally.
In today's news recap, silver price breaks $44.22 as gold strength fuels bullish price prediction. Spot silver surged through a multi-year resistance at $44.22 early Tuesday, extending gains to $44.43, the highest level since the last major bull cycle. With gold pushing to all-time highs, silver continues to attract spillover buying from traders positioning for further U.S. rate cuts and inflation protection. The breakout confirms the broader uptrend as silver tracks gold's move, supported by dovish Federal Reserve expectations and renewed physical demand. Gold's rally was triggered by last week's 25 basis point rate cut, the first of this cycle, and further fueled by calls for aggressive easing from new Fed Governor Stephen Moran. Traders are now pricing in 2 more cuts by year-end, with October's meeting carrying a 90% probability for the next move, according to CME FedWatch. Silver, like gold, benefits directly from falling yields and a weakening dollar. U.S. 10-year Treasury yields dropped to 4.129%, while the 2-year yield dipped to 3.597% ahead of Fed Chair Jerome Powell's remarks and the U.S. flash PMI releases. A softer tone from Powell could further reinforce the bullish backdrop for precious metals. As a non-yielding asset, silver's appeal grows in a low-rate environment. The rally is also being supported by strong physical demand, particularly from industrial buyers and Asian markets. Meanwhile, ETF inflows in both silver and gold signal renewed institutional interest. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
I'm not sure of that. I know they could because technically we ran a spread chart, meaning divided the price of SIL, the popular silver miners ETF, against the price of an ounce of silver. And when you express that as a percent, you get a chart, okay? And it has technical attributes to it that suggests that you're pressing toward a breakout level right now, meaning a breakout in performance of the miners versus gold. And in contrast, for example, SIL right now is still $20 or so short of its 2011 price high, which was like $90 plus, okay? GDX, the gold mining ETF, is above its 2011 high, just like gold is, and yet the silver miners, just like silver, are below their 2011 high, and we can see the catch-up occurring quickly. And also, silver miners are at a point of breakout in performance, I'm talking about, versus the gold miners. So we're emphasizing silver. We think that it will outperform gold, and we think the silver miners will outperform the gold miners. And the question you're asking, will the silver miners beat silver? It's possible for a while. I don't think it's a big issue. I think the main emphasis that investors in the monetary mining sector should look at is emphasizing silver side of that equation. Just like in the bullion area, I'd emphasize silver. I think the percent gains you'll see there will handily beat gold. State what we've said before, the stock market is a major bubble in history of U.S. stock markets. No other bull market has had this kind of multiples over this period of time, and it is largely due to, look at an M2 chart, you'll see the growth, parabolic, and it's simply keeping up with the decay in the money unit. But and for 15 years, we've had free money 10 of those 15 years. And even when they raise rates to 5%, I'm talking the short end of the market now, and you go back 75 years and look at a Fed funds rate chart, even that 5% is in the lower quadrant of the past 75 years of rates. So we've had, in effect, what I call a Cheech and Chong rally, high on drugs the whole way. And a lot of that money flow went into the stock market to an excess. When those bubbles break, they're horrendous, because errors are exposed, and you don't need a new headline to take it down, like a war in Europe or something like that. It will go on its own because it is done something excessive, just like we've been talking about regarding silver. It's done something that's excessive and prolonged, and when it makes up for it, it's dramatic. I think the stock market, by the way, right now, when we look at its metrics in the weekend report, we had I think it was a 100-day moving average oscillator. And it has structure that we're about to challenge right now as you and I are talking. A little about another 0.5% below where we are. You're going to trigger a structure that you cannot see it on the price chart, but you can clearly see it on the momentum chart. It's a floor that's been used like 4 times on momentum since July, whereas on price you have this upward incremental crawl ever since we got above the January, February highs in the S&P, which is like 6140. Everything since then has been like 0.25%, 0.5% week, et cetera. Incremental, yet new highs. But during that time, momentum has built a floor that says, you break me, I'm going to take you down. Now, the problem is if you're long the stock market, we're arguing we've been in a developmental top process since late last year. Yes, new highs that occurred in 2000, mid-2000, after we predicted a high in January. It occurred in October of 2007 after we'd predicted high occurring at a certain target zone. That was a Fed rate cut that helped cause that high, just like we just had. You don't want to get back below the prior high. Well, for the S&P, that's 61 plus. Right now, we're pushing towards 6,600. Well, we're talking, not a lot of percentage points. So if you get an intermediate term break in the stock market, And everybody says, oh, that's fine. You don't want to get back below that January, February high, because if it does, then you're saying, oops, that wasn't the breakout I thought it was. It's a failed launch. That's when you get into the deeper stuff. And I think that's likely to occur. And when it does, it will have wave effects.
What do you think of his take? Do you agree with him? Is a big rally coming for gold and silver before a big top forms, or will gold and silver outperform all expectations? Let us know your honest opinion in the comment section down below. Smash the hype button if you enjoy our recaps, and check this video right here because you'll love it. I'll see you on the other side.